I think there's a false narrative around what makes a good investment, and I think part of that is born out of the survival bias. I think when people look at their portfolios today, what they see are those companies that have performed well, and they intuitively feel that those are the sorts of companies that they should have invested in from the beginning. I think the problem with that is what you don't see is all the companies that you initially bought or that made up, let's say, the index that didn't make it to today. So for example, if you're looking to buy a high quality portfolio, and I prefer to use the word high quality rather than blue chip because blue chip means different things to different people. But if you're looking to buy a high quality portfolio back in the 1980s, you probably would have avoided BHP, which at the time was probably more considered a punting stock than a high quality company. Instead, you might have bought a HIH. Similarly, in the 80s and 90s, you would have probably avoided a Westpac, because Westpac, of course, was on its knees at that time, and you would have thought, it's not a high-quality company, best to avoid those sorts of companies. Instead, you might have bought an Ansett. So what you find is, just because something is a big company and is a successful company now, doesn't mean that you can focus on buying big and successful companies now and assume that you're going to get positive results or similarly positive results going forwards. I think what you need to recognize is that the companies that you want to own are the companies like BHP and Westpac back before they were considered blue chips. So what you're looking for are growth companies. If you're looking for secular positive returns, you can't buy mature companies. Mature companies don't have any reason to see the share price go higher except for perhaps a PE expansion. What you want to find are businesses that have growing earnings. If you can find growing earnings, those are the sorts of companies that you want to invest in for the longer term. What we're looking for now is high quality businesses that are cheap. And normally they're cheap for one of a couple of reasons. Where we've found the most ideas recently is good quality companies that have had a one-off issue that has seen the share price get smashed. So once we can establish that it's not structural, once we can establish that it is legitimately a once-off, we can get comfortable buying these high quality companies at excellent multiples. We were following iSelect for quite some time. It's been on our watch list for a long time, actually. We met with management after they'd fallen from about $2 down to $1, and we started getting comfortable that the business was okay for the long term. Not the best quality company in the world, but a good quality company. So when they came out about a week after we met with management with that big downgrade and the share price fell from about $1 down to 33 cents intraday, we felt comfortable enough knowing that we understood the business that we could press a button and buy that business, a substantial amount of that business. Again, I'm not sure that iSelect will necessarily become the multi-billion-dollar company of tomorrow, but I am pretty comfortable that buying it at less than its net asset backing, at less than its fire sale value, ignoring the ongoing business, we're comfortable that we can make money over the medium term in those sorts of companies. So again, because we do have some concerns about the indebtedness of the Australian consumer, because we do have some concerns about the broader economy, our preference at the moment is to not look for growth per se, because it's very hard to measure earnings when you're not sure of what the future looks like. We're looking for good quality companies that have been absolutely smashed because they've gone through some sort of one-off event, and that's given us the opportunity to buy them cheaply.